What up, YouTube? It's your boy Charles Enoch. You know, we back with another Invest in Myself episode. So let's get it started. Okay, so today we're going to be discussing a real big topic, and that is how to pay your mortgage in a third of the time. So there's been people asking me when I was going to go over this topic, and I know it's taking me a long time to cover this topic, but the wait is over. But first, some real quick things I want to go over. So you know your boy's 100 subs away from reaching 1,000 subscribers and 500 hours away from reaching 4,000 hours total. So what I need y'all to do, help a brother out. So if you're new to the channel or you just haven't done so yet, go ahead, take a little time, hit that subscribe button down below, hit the like button, and go ahead and comment and let me know if this information helped you. Also, if you know somebody that has a mortgage, share this video. If you know somebody that's going to get a house in the future, share this video. This method I'm going to show you is literally going to save you thousands of dollars in interest. So please spread the word, share, and share. All right, with that being said, I'll be using the computer screen today to show you how this method of paying down your mortgage works. Let's go.
All right, so we have the mortgage amortization payoff calculator, and just kind of go over all the values that's in the mortgage payoff calculator here. So we have the loan amount, we're going to say it's $200,000. The annual interest rate, we're going to say 5%. Usually most people have a 30-year loan, and number of payments per year 12. We're going to start the loan as of today, April 2nd. So the scheduled payment around close to $1,100. There's 360 payments you have to make. That's the 30 years. So the first concept I want to show you guys is the traditional way of how everybody pretty much knocks off years off of their mortgage, and that's the bi-weekly payments. So with a bi-weekly payment, you're paying the mortgage every 2 weeks, and what that pretty much does is it adds an extra payment at the end of the year. So you're going to have 13 payments instead of 12. Now what we're going to do, we're going to see what bi-weekly does, how much interest we save, and how many years that we knock out. And the way that we're going to do that, we're going to add extra payments. So if we're going to round the scheduled payment, let's say up to $1,100, divide that by 12, that's like $92 extra. So when we put that in, we can see the actual number of payments is going to be 302. So it went down by 58 payments. If we divide that by 12, that's going to equal 5 years off of your mortgage just by doing bi-weekly. Now the total interest is 151,000, close to 152. If I back, it was 186. So that would be the difference between doing the bi-weekly as opposed to just doing every single payment for 30 years. So that would save, if it was 186, pretty much a total of $34,000 just by doing bi-weekly. Now bi-weekly is cool. I just wanted to show you guys about the bi-weekly method, which everybody knows, but we are wanting to get into pretty much a method that is going to knock it down to about 10 years to pay off your mortgage. All right, so now we're going to get down to how to knock down your mortgage and pay it off in a third of the time, pretty much in 10 years. So what we are going to be doing, we're going to be borrowing other people's money, pretty much borrowing the bank's money. So what we are pretty much looking for, we are looking for credit cards that will offer a free balance transfer and for a number of months. So let's say that we applied for a credit card, and we got a $20,000 limit on the credit card, free balance transfer, and it's for 20 months, 0%. So what we would do, we would transfer that balance. We could either use the convenience check and put it into our account so we can have the money, or a lot of times the banks can just transfer the balance from the credit card to your account. Either way, we're going to get the $20,000. Now, what we're going to do day one of the loan, we're going to put that $20,000 in there and put it towards the loan. Now, before I enter this in, we see the actual number of payments, 360, and the total interest, 186. Let's see what happens when we put that 20 in. Boom. We see the actual number of payments are down to 289. So that went down by 71 payments. That's pretty much 6 years of mortgage just completely gone with that $20,000 extra payment that we got from the bank. So we see the total interest of 129 now. So interest was 186. So we saved about 56,000 off of that first chunk payment of 20,000. Now we're going to say this individual, they get $1,000 of cash flow every single month. So in 20 months, they would pay off their credit card. And remember, it's 0% interest. So we're going to say we're going to have a scenario that this individual keeps on getting balance transfers of the 20,000, and then they'll pay it off in 20 months. So we'll see what this does here. So see, 1 2 3 4. All right, so the month 20, I'm gonna put another balance transfer. Let's say that they got another balance transfer offer, the same thing again, the 20,000. We'll put that in. And we see that the interest and the early payments, the actual payments, are getting reduced every time we put that in. So what I'm doing here is just putting those $20,000 in every single 20 months. And we just seeing these payments just go down. All right. So this individual kept on getting credit cards, or they had a credit card and they kept on getting an offer every 20 months of a free balance transfer, and it was for 20 months. They had an extra cash flow of $1,000. So they're going to still be making their regular mortgage payment, but with their extra cash flow, they're going to be paying off the credit card until that $20,000 balance is full. And they're going to keep on repeating that. And what we see here is, if we would have just did the regular monthly payments, that's 360 payments. Now, since we did chunking of $20,000, the actual number of payments that we made is 120 payments. So 120 payments, that's pretty much 10 years worth of mortgage. So the total interest that we had was only $50,000 as opposed to $186,000. So that is pretty much a major difference. So pretty much what we're doing with the Velocity Banking strategy, we're using the bank's money by exercising those free balance transfers, and then we're putting that towards the mortgage. We're chunking that towards the mortgage. First payment, we're just going to chunk that into the mortgage, and it's going to completely obliterate a lot of that interest. And we're going to be rinsing and repeating. And again, it doesn't have to be $20,000 payments. Let's say that you get a credit card and it's $12,000 and you have it for 12 months, 0%. You would do the extra payments for the $12,000. I'm putting in an example. Now, again, this does take some legwork here. So you are going to have to be researching credit cards, banks that offer this balance transfer for the 0% and for a number of months. So it is possible, but you are going to be doing legwork to get this completed. Now, again, it is definitely worth the legwork of researching which cards that you need, which cards that you can get, so you can do those extra chunk payments. Because we are saving so much interest. If the interest is only 50,000 and we did it for 10 years, that's a third of the time. So this is the method that you would want to exercise. And we're going to have another example that I'll show you here that will use a lesser amount, and we're going to see if we can actually match that 100 and only 120 payments, only 10 years to pay off the mortgage by chunking the bank's money and then paying them back because they're charging 0% interest. All right, so we're going to do another quick example with a lower amount and see if we can still get to that only 120 payments paying it off within 10 years. So again, what we're doing, we're getting credit cards from the bank, or if you have a credit card, we're utilizing balance transfer offers that are 0% for a certain amount of months to make a big chunk on our mortgage. And then with our cash flow, we're going to be paying the card off while still paying the mortgage with our regular income. It's just the cash flow will be put into the credit card to pay it off. So for this example, we're going to say an individual that applied for a credit card, they got a $12,000 offer, balance transfer 0% for 12 months. So we see again the total interest, if we were just to pay the mortgage just straight out regular payments, 186. It would take 360 payments, 30 years basically. So let's put this $12,000 in and see what happens. So we see that the actual number of payments gets reduced by 45 to 315. So that's knocking out 4 years of mortgage payments, which is crazy. That's really crazy. So remember, the total interest was the 186. It reduced down to 100, and we'll round it up to 150K. So that's a total savings off of one transaction, off of one lump payment of 36,000, about $500 saved. So we're gonna go for 12 months. Remember, the extra cash flow is paying off the card, and then we're going to utilize another balance transfer offer, or we can get another credit card. Let's say it's $12,000, 0% interest for 12 months. So we're going to do this cycle and see what happens, see if we can get down to 120 payments. So let's see. So boom, we see it going down. Boom, and just keep going. We're still going. All right, so we're finished here. So bam, we see that even if we did $12,000 chunks, the actual number of payments is 121 payments. Pretty much still 10 years. And one thing to note too, I didn't say it on the last one. This last payment, the balance is only 3,826. I put 12,000, so you wouldn't even have to use the whole 12,000 on there. But the whole concept is, if you have an extra payment, no matter if it's 20,000, 12,000, you're still going to get close to this number of 10 years. I think the last one was 120. Now, one thing to mention, the interest that we did pay was a little bit more because our chunk payments weren't as big. So the more that you can chunk in the front of the loan, like the first payment, let's say you put $50,000 in, it is going to pretty much delete a lot of the interest, because we have to remember that mortgages are front end. All the interest is at the front on the first payments. So if you're chunking at the very beginning, you're going to save a tremendous amount. But again, don't really worry about the amount. Whatever you're approved for, whatever balance transfers that you can get for 0%. And again, you have to have constant cash flow. So if you constantly get $1,000 or you constantly get $500 left over, you're putting that into your credit card. So you want to see how much you can chunk based on your cash flow and what the bank offers you. But again, we do see that we're saving a hell of a lot of interest. 186 was the interest, now it's 52. This is definitely killing biweekly. Biweekly, I think we saved about 5-6 years. We are saving, knocking 20 years off just by using this method. And again, I know you have to find credit cards, you have to find these balance transfers and things, but it is definitely worth it. If you can get your mortgage paid off in 10 years, it is worth the hassle of calling banks, getting the balance transfers that you need so there's 0% and you can make that chunk. So I do want to go over one more quick scenario because I know I'm going to get the question, Charles, if I have $1,000 extra cash flow every month, why don't I just use that as an extra monthly payment? I don't even need to apply for a credit card with 0% balance transfers and all of that. So let's do it. Let's see what pretty much happens. So what we're going to do is just put every extra payment of $1,000 a month and see what we get here. All right. So the actual number of payments, 125. So it's not 120 or 121. I mean, you would have to pay 3, 4, 5 more payments if you did the method of just putting an extra payment every single month out of your cash flow. Now, one thing to look at here, the total interest is $56,000. If we did the $12,000 chunks, we were at 52. If we did the 20, we were at 50. So the total interest, you actually are paying more. And the reason is because at the front, the front of the loan is where all the interest is. So an individual that it is making an extra payment of, let's say, $20,000 just to begin with, it is drastically reducing the interest, as opposed to somebody that continuously just pays $1,000. So yeah, you can get pretty close, but just know that you're probably going to be paying more in interest. And $6,000 more, to me, I'm going to be looking for the balance transfers and calling the bank. That's a whole trip somewhere or something. So $6,000 is very crucial to me. Some people, it may not be worth the hassle. But yeah, if you just did extra payments of $1,000 every single month, you get pretty close, but no cigar. So if this video was helpful, if you like me being on the computer screen and showing how to pay off mortgages in a third of the time, definitely comment down below, hit the like button. Again, for individuals that have not subscribed, go ahead, take a little second, hit that subscribe button for me, help a brother out. And you guys have a beautiful weekend. I will see you guys next week. Peace out.